Now we talk about liability. What is a liability? Liabilities are the claims of the proprietor and outsiders. So, any amount which the firm owes to the proprietors and outsiders is a liability for the business. So, they can be claims of the proprietors to the business or the claims of outsider to the business. So, they are the obligations or the debts which the business owes, not owns. It owes to the outsiders. Now, these liabilities can be external liabilities and internal liabilities. So, what is the difference between an external liabilities and internal liabilities? So, external liabilities, as the name suggests, are those liabilities which the business owes to the outsiders for the goods purchased on credit or for any expenses or loans that have been taken from banks and financial institutions. So, these are the amount which the business owes to the outsiders, either on the creditors or from the banks and financial institutions. So, these are some of the examples of external liabilities: bills payable, bank loan, outstanding salaries, sundry creditors. Now, internal liabilities. Internal liabilities are those liabilities which the business owes to the owners or the proprietors. So, that is why the word internal. So, the liabilities are owned by the business to its internal owners or the proprietors. These are the amount contributed by the owners towards the business, and it is constitutes and it is the liability for the business concern. So, the business owes this amount back to the proprietors and the owners. So, these are some of the examples: capital, interest on capital, profits of the business, the undistributed profit, and the reserves and surpluses that it has made over the years. Next accounting term is revenue. Revenue constitutes the inflow of money or other assets that results from sale of goods or services provided or from the use of money. So, it is the amount realized or receivable from the sale of goods. So, it is a reoccurring item, it is a regular item, it is regular in nature, and it is concerned with the day-to-day affairs of the business. It should be calculated in the period in which it is earned or it is realized. So, the sources of revenues could be sale of goods, rent received, interest income received, dividend received. These are all categorized and clubbed together as revenue. Then comes the item of expenses. What are expenses? All cost incurred in earning revenue is called as an expense. It refers to the cost which is incurred in acquiring an asset or a service. It is the amount spent in order to produce and sell the goods and services. Example, transportation cost incurred in transferring the raw material. So, some of the items of expenses can be wages, cartage, rent paid for the office or for the factory, insurance premium, etc. Another accounting term is expenditure. Now, expenditure, there is a difference between expense and expenditure. Expenditure we generally relate to the amount spent on the purchase of assets. So, it is used for the purchase of fixed assets, which is going to increase the profit earning capacity of the business. So, the expenditure on the purchase of furniture, machinery, building, land, etc. would be called as expenditure. Next accounting term is profit. What is profit? It is the excess of business revenue over business expense over a period of time. So, it is the difference between the total revenue generated during the period and the cost involved in generating the revenue. So, the difference is referred to as the profit. It is an addition to the owner's equity. In contrast, there is loss. So, when the cost is more than the revenue, it results into losses and it decreases the value of the net assets. So, what is losses? It is the excess of business expenses incurred over the business revenue earned during the year, and it decreases the owner's equity. So, in contrast to profit which increases the owner's equity, losses brings down the owner's equity. Next accounting term is purchases. Purchases means the purchase of goods and services in which the firm deals. So, if an automobile dealer buys cars, it will constitute purchases. But if it procures land or building, it will not be a part of purchases. So, what is important here is that purchases will constitute only those items in which the business is dealing. So, an automobile dealer, since he deals with automobiles, so any purchase of automobiles would be a part of purchases. What are sales now? Next item. Sales means the exchange of goods and services for the money again in which the firm is dealing. So, if the automobile dealer is selling goods and services, so the money that he earns or realizes on the sale of those automobiles would be sales. But if he sells land, building or any other consumable item, then that will not be a part of sales for the automobile dealer, because he is not a dealer of the automobile. So, sales will constitute only items pertaining to the business. Next accounting term is stock. Stock means that all goods and merchandise that he has purchased for the sale in the ordinary course of business. So, it constitutes the raw material used for producing or manufacturing goods, the semi-finished products or what we call it as work in progress, and finished products or goods. Another important accounting term is a debtor. Now, what is a debtor? Debtor is a person who owes money. And on what account? So, debtor owes money to the business on account of goods sold to him. Added terminology to debtor is receivable. So, in addition to debtors, there may be some other persons who owe money to the business. They are called as receivable. So, this includes bills receivable or accounts receivable. Next is creditor. Creditor is a person to whom the business owes money on account of credit purchases. Many number of times the business buys and purchases raw material but does not give an immediate cash benefit. So, to these persons the business owes money on account of credit purchases. So, these people or this firm would be referred to as a creditor for the business. Now, in addition to creditors, we have payables. Now, there may be some persons to whom the business owes money. So, this would be part of bills receivable or accounts receivable. Now, what is debit and credit? Since in accountancy, we follow the concept of dual accounting principle. Dual means double entry. So, in business transactions, all financial or business transactions have two sides. One is a debit side and the other is the credit side. And for a financial transaction, the debit amount should always be equal to the credit amount. Now, double entry bookkeeping. Now, the practice of having equal debit and credit is called as the double entry bookkeeping. Under this system, every transaction has a dual aspect or two aspects. One is the debit aspect and the other is the credit aspect. So, at the time of recording a transactions, we have to be very careful that both these aspects are recorded, the debit aspect as well as the credit aspect, because then only it will equalize the transactions and the double entry system would be systematically followed.